Hi, Matt Battye here again. Just wanted to give another quick market update. Hasn't been that long since we sort of delved into what's going on in markets, but there's been quite a bit of activity, a bit of volatility around. So I thought we'd just touch on a few things, sort of see how things are playing out in line with what our expectations were and what we talked about last time. So let's get into it. So the first thing I'd say, what's changed? Well, the short version is really nothing. The big theme still, from our perspective, is inflation versus CPI, and I won't go into in a lot of detail about that because we did that last time. But really, it's about prices being elevated because of the money supply, or prices being elevated because of supply constraints, and that's really kind of what we're looking at. And the main thing we're really focused on there is energy. Energy is the most important thing from our perspective because the price of energy ultimately determines the price of everything else, and it essentially compounds through the supply chain. So the energy availability and the price of energy is still very much on our agenda, particularly as Europe heads into a winter and is facing quite a few potential energy shocks in there. Some of those CPI factors, though we have seen them decrease, we are seeing energy prices come off a little bit, particularly we're seeing petrol domestically. Things like shipping costs have come off to some degree. So we are seeing some of those supply constraint price factors reducing a little bit, and we'll see that feed into the CPI number in the coming months. But we still see a very significant amount of inflationary effect in that, and that is, really the money supply we've talked about before. But the other thing we're really starting to see now is the effect on property, and property prices really sort of going into a bit of a free fall, and I'll touch on that in a bit of detail as well. I guess one of the things to really be aware of, though, is despite the fact we've now had 5 rate rises and many of those at 0.5%, so we've seen an unprecedented amount and rate of interest rate rise in a very short space of time. It's really not being felt yet. If we look at things like consumer spending, and sentiment has changed to some degree, but behaviour hasn't yet sort of caught up with that. So that's one thing to really keep in mind as we look at this point in time, is we really don't feel like the effect of those rate rises have come in yet, and certainly the measurement of those, because of the timing and lag, measuring that behaviour is yet to come as well. So that means we'll continue to get, let's call it bad news if you like, for the next few months, as some of those inevitable measures and behavioural changes actually start to hit the statistics, if you like. But the inflation effect's still very real. So, and by inflation I mean the amount of money in the system, the money supply. One of the things that is potentially a bit of a concern to us is we're seeing that change from the quantitative easing and the lowering of interest rates by central banks being reversed to quantitative tightening now, and that is essentially bonds dropping out of the market, and also interest rates being increased. But we're seeing the response to that, both particularly in the US with the inflation fighting bill that's recently been passed. Somewhat ironic that a government can fight inflation by creating more money, but that aside, we're seeing a similar response in Europe, and particularly with the new Prime Minister in Britain also signalling that the way that governments are going to address the price shocks to households is by simply giving them more money. Now, in the short term, that can seem like a very sensible kind of measure because, and certainly from a political point of view, it's very efficient and expedient because it can be seen to be doing the right thing. The problem is interfering in a market in a way that has created this problem can't be fixed by interfering in a market in a way to try and alleviate the political pain from that problem. So it doesn't necessarily mean that it's a bad idea to do something. Obviously, we can't just let things run amok, particularly because markets are unlikely to fix in the short term a problem that markets didn't really create. So it's something we'll keep a very close eye on, but it also means to some degree, while the Reserve Bank and Federal Reserve are addressing their changes in the past, some cans are still being kicked a little bit further down the road, and that's something we need to be really mindful of. Now, the other thing, I guess, to keep in mind is some of the numbers are still very good. We've still got very low unemployment rates. We've just come through a record earnings season, particularly here in Australia, and distributions are extremely high, and there are actually a lot of businesses, a lot of companies with a lot of spare capacity in their balance sheets. So we are going to see a lot of, we've seen some very healthy dividends. We're going to see a lot of capital returns potentially and sort of one-off payments. We probably won't see too many in the way of special dividends because a lot of companies will recognise that their ability to continue to pay, increased levels of dividend in future years is probably not strong. And so there'll be things more like share buybacks and other forms of capital returns potentially. So, but there is a lot of cash, within the within a lot of businesses that will find their way back out into shareholders' hands. And then the reverse of that is we still see a lot of zombies in everyone. I'll go into that in a little bit of detail, precisely what we mean by that, but essentially companies that really do not have very good financial strength. So expectations, this is a graph we touched on last time, in looking at what the expectation for interest rates, really the change in sort of where the Reserve Bank will sort of, and Federal Reserve will sit in terms of interest rates. And we've pretty much hit that sort of December number now. The RBA's raised rates up into that sort of level. It was only in August that expectation had risen quite considerably. And we're well ahead of that in terms of the time frame. So the August line is very much where we're heading towards from a market expectation point of view. But we still feel that that's probably going to be overdone, and certainly at that rate of increase is probably going to cause a few problems. And we'll look at the effect of that's happening on the property market in particular. And one of the reasons we're sort of looking at this is because of the effect, what we're seeing happening in New Zealand. So New Zealand, as you can see from this graph, started raising rates earlier and at least aggressively in Australia. And we're really starting to see a lot of very significant pricing pressures in New Zealand. We're already starting to see people essentially, calling in sick because they can't afford the petrol to go into the office. So there is quite a bit of potential political fallout that's starting to happen in New Zealand as a result of, this sort of inflation fighting actions, and they're sort of slightly ahead of us. So they do provide us a little bit of insight in potentially what's coming down the track for Australia. So where are we with property? Well, the core logic, which is probably the best source of data that we look at from a residential property perspective, if we look at their August numbers, both the 5 capital cities and the 8 capital cities index had their largest single monthly decline since the early 1980s. So what we're seeing in Sydney in August, Sydney prices were down 2.2% in the month, so getting to an annualised rate now of nearly 20%. Melbourne at 1.2, slightly lower, but still a very significant sort of 13% annualised sort of rate. So we are seeing some very major sort of price drops in property there. Brisbane was down 1.8%. That's actually the largest fall on record for Brisbane, going back more than sort of 40 years worth of data. And we're now seeing Adelaide and Perth sort of in decline. Probably really important to note there that, Sydney's now approaching a sort of about an 8 and will soon be about a 10% peak to trough sort of decline. Melbourne's sort of sitting around the sort of 5% and heading down. So not catastrophic in the sense that we really haven't got back to the pre-coronavirus levels yet. So anyone who has held property investments for certainly pre-corona is still sitting on reasonably healthy balance sheets, most likely, but we are seeing a pretty precipitous sort of drop in property prices. So that's certainly something we're going to keep an eye on, because the wealth effect of that can tend to have a big impact on people's spending habits and how people feel about spending money, particularly discretionarily in the economy going forward. So. But one of our biggest concerns, I suppose, from a market perspective and a market positioning point of view is what we refer to as a sort of zombie company. So to the degree there's an official definition, a zombie company is generally referred to a company that's been around for at least 10 years and has an interest cover ratio of less than a year. In other words, their profit doesn't cover their interest, their interest payable in the next 12 months. And we look at the sort of state of zombie companies across the ASX at the moment. They're sitting at around about 13% of companies meet this definition. If we look at the US, if we look at the New York Stock Exchange and the NASDAQ, they're sitting more around sort of 10%. But we have a bit of an issue with that definition in the sense that it really doesn't matter how long a company's been around. What we're mostly interested in is the health of all companies at a particular time. So if we peel that back and say, well, how many companies didn't meet that definition for the last 3 years? In the ASX, that now increases to about a third, or just over a third of companies listed on the Australian Stock Exchange haven't been able to don't meet that definition from a profitability point of view over the last 3 years. In the US, it goes up to 19%. And in fact, if we look at that over a 12-month period, we're getting close to 40% of companies listed on the Australian exchange and nearly the same in the US, over the last 12 months have not made enough profit to cover their interest. And the reason that's significant for a couple of reasons. One is interest rates on the rise means that measure is going to get exponentially worse. And therefore, companies that don't have essentially the balance sheet strength and the access to capital to be able to fund continual growth could really come into some serious, facing some serious problems going forward. And particularly when we're talking about a very large portion of the market, we could see some very large effects in terms of how that might play out from an index perspective in particular, but also sort of positioning portfolios. So it's by no means the only metric. There can be lots of reasons why, a company who fails this metric could be a very strong company. But as a general rule, it's, if you don't have enough profit to cover even just the interest, let alone the capital repayments you might have to make on your debt for the next 12 months, it's not a great sign potentially. So, companies that aren't going to hit profitability in the next couple of years, they're facing this sort of measures, we would have a pretty deep concern. And given the potential size of that in the market, obviously it's something we're keeping a pretty close eye on. And yet, just another reason why we are very active management biased, in the sense that we really do want to be very careful about what it is we have money invested in. And so sort of blindly buying indexes, whilst that can be effective in creating good median sort of returns, the times that can really hurt you is when cycles are changing and when, indexes can be sort of, more filled with, shall we say, companies that may not have good long-term sort of prospects. Why are we keen on cash? Well, one of our key principles here is cash flow is always king. So, and not necessarily just in the sense that it's nice to have great cash flow, because obviously we need to make sure that whatever cash flow we are receiving is sustainable. So there's lots of examples, and we talked about that in other videos, where high yielding or high cash flow paying businesses are often the worst to own, because the reason they're paying that out is because there's no growth in the business and the business can be unsustainable. So just having high cash flow isn't necessarily a great thing, but making sure we have ready access to cash flow is always important in portfolio management, because cash is what we spend. And so making sure that we hold sufficient cash to allow us to continue to participate in markets during periods, particularly like we are now, where it's quite volatile. And we really want to be very careful about making sure we're not exposing ourselves to too much sequencing risk by having to sell out of markets during this period, during these sorts of periods, to fund cash flow, making sure our cash flow is, and access to cash flow is sort of baked into the portfolio. So, cash is how we ultimately require real assets, right? It's what we use to buy the products and services that we, that sustain our lives. So having access to cash is really, really important. Sufficient liquidity to do that is the key, though, to being able to access long-term returns. Being able to keep our money, patient in the market is really a function of making sure that we have enough cash flow day to day, and we don't have to participate, in buying and selling in those really sort of volatile times. Because at the end of the day, when we look back over, the long term, it's that average return that matters, and the compounding of that return that matters. And so trying to maximise that long-term average return is ultimately what portfolio management's all about. And the way to do that is to make sure we're not stuck in liquidity issues where we're having to sell sort of at the wrong time. Because, at the end of the day, if you look at the mathematics of return, it's that earnings growth we get out of a portfolio versus the price that we paid that's ultimately going to be the driver of the return. So we've got some discretion or some ability to influence the price that we pay by being very careful about when and how we buy and hold the stocks that we hold, and stocks that have reasonable earnings prospects given their current sort of market prices, if you like. So, but not having to sell out of stocks to provide liquidity at the wrong time is obviously a key part of maintaining that. So what does the future hold? Well, for us, it's the mantra is still true. Price is what you pay and value is what we get, and earnings ultimately are going to drive returns. So what we are seeing is very much, we've talked about it previously, is we're seeing that value rotation theme very much sort of continuing, which means that from our perspective, from a portfolio point of view, we believe we are well positioned for this sort of rotation. We are continuing though to explore what we refer to as sort of macro dynamic tilt. So looking at themes, that areas of the market or areas of the economy that will have better tailwinds and have less headwinds going forward, and the ability to be a bit more dynamic of putting those sorts of things in the portfolio. So we always have to be very careful when we look at making changes to the portfolio that they must be risk effective and cost effective. It's very easy to look at certain things, differences, changes you can make to a portfolio that might make a difference. But at the end of the day, making those changes to only end up costing more than they return, or ultimately increasing the risk portfolio is obviously not a sensible thing to do. So being able to do it is one thing, but also making sure that there's going to be some reward for doing so. Obviously, we continue to continue to monitor both the investment managers that we are currently sort of working with and recommending, and also potential alternatives, particularly if we do see that there's a need to change positioning the portfolio because of macro changes or changes within investment teams. And looking at not just how they're positioned in the portfolio, but what is their execution performance. And are there some potential alternatives we should be considering? But one of the key things we look at there always is to make sure that whatever our managers are investing in, really adding diversification to the portfolio. What can often happen during these periods of times is we get a real sort of rush to the same sort of theme, and we end up seeing some unintended portfolio risks sort of creep in, where when you look across a portfolio, it might seem like it's diversified, but when we consider all the potential underlying risks, you start to see there's a one or two risks that actually now are fundamentally, there's an exposure across the entire portfolio that no individual positioning in a portfolio is really taking a major stake in. But if you look at the portfolio as a whole, you're now creeping in, something that's very sensitive to interest rate movements or different geopolitical risks or some of those sorts of things. So that's also something we're very mindful of, is to make sure we're looking through portfolios to understand that are we really diversified and we're not all sort of reverting to the same underlying risks. So going forward, we think, look, the volatility is probably going to continue through, I think, probably the rest of the year, maybe early into next year. But we are seeing within those, within markets, there are plenty of opportunities to invest in lots of assets, lots of companies that have reasonably resilient, reasonably predictable earnings profiles that are, from a valuation perspective, quite attractive. So at this point in time, yes, we feel like the volatility is probably going to continue while a lot of this data sort of works its way through the system, in terms of particularly that inflation versus CPI story. But we do feel like there's plenty of opportunities there to remain invested and be ready there, as things start to recover, which may come sooner rather than later, but volatility could continue into next year. So just one last thing I want to touch on is we often, during these periods of time, people can sort of, there's a temptation, I suppose, to sort of look at saying, well, why not just sort of, if we think market's going to be volatile, why not sort of cash up and go back in when things are a little bit more certain? And we've addressed this in a number of other videos, but I just want to touch on it just briefly for those who haven't seen those potentially, but also just as a sort of quick reminder that really when we're looking at making changes in a portfolio or making recommendations to clients, we're always looking at what we call demonstrated versus speculated. It's very easy for people to look at things, once something has worked, and say, that was a very obvious thing to consider. But the challenge really is prior to that is understanding, well, what will work and why. And so the way we kind of like to look at it is a little bit of a principle that we call foreseeable, predictable, actionable, and profitable. And really what we mean by that is we're looking at, what are the things we can foresee happen? There's always plenty of things that we are mindful of or worry about. But they need to be at least predictable. They need to be time bound. There need to be some trigger or something that some degree of predictability, so that therefore we can take some action. Because if we don't know what's coming and we really can't take any action for it, all we can be is generally prepared. So what we're looking for is, can we get that to be actionable? And just because something's actionable, again, doesn't necessarily mean we want to take advantage of it, because we have to be able to make a profit from doing so. Again, there's no point making change to portfolio, no point rotating out of this versus that, only to put ourselves in a position where at the end of the day, we're really no better off and we've realised some tax, we've paid some fees, and we haven't really materially changed the risk dynamic of the portfolio. So that's something we're very mindful of in terms of why we don't make changes, particularly during volatile periods, because many of the things that we look at really don't pass all those filters. Yes, they're foreseeable. We know where rates are likely to go to. Yes, it's predictable about how far and soon that's likely to occur. Is it actionable? Yes, there's things we could do that if that plays out, that there's a reasonably, there's different sort of trades that we can make, but would they be profitable? And also, what risks are we introducing in the portfolio result? And it's only when things make it through that entire framework that we would consider actually making physical changes in a portfolio. One of the reasons why we like to revisit this is because during these periods of time, it's not uncommon to see a lot of sort of market commentators, shall we like, or experts sort of come out with a lot of data or predictions that, or apparent predictions that seem like they were relatively obvious at the time. So look, we'll continue to obviously monitor things. If there's any material changes to outlook or our views on things, we'll certainly give another update. We'll always welcome any questions or queries anyone has. Please let us know if there's any topics or any issues or terms we've talked about we want to go into more detail. More than happy to do that at any point in time. But as we stand at the moment, we're really happy where we're positioned, and we're looking forward to markets getting through this sort of cycle and returning to let's call it a much more sort of normal mode of operation. But as always, we thank you for your support, and we look forward to seeing you again soon.